you can do by buying an index fund, you can do better than 80% of Wall Street and 80% of the pros by just buying an index fund that's as close to free as possible. And there actually are some out there. Again, we're not sponsored. We don't get kickbacks from anybody. Vanguard is traditionally the low cost fund leader, but Fidelity has started selling free mutual funds, which is pretty amazing. But again, it's just an index fund. It's run by bots that don't cost anybody anything. Welcome to Service and Wealth, the podcast dedicated to helping military personnel master their finances and achieve financial freedom. Our mission is to guide you through the ins and outs of planning, saving, and investing, and most importantly, how to balance savings so you can enjoy life now and retire with confidence. We are back. This week is week 3 of our investing mini-series, I guess you could call it. And this week, I got to admit, we're taking a little bit of a risk. So I am currently in the upstairs kind of office space at my parents' house. We're visiting them out here in Montana. It's, like 100 degrees outside. They don't have air conditioning. I'm basically in the attic, and the neighbors are all out there with their weed whackers just going to town. Apparently, that's what you do, in the middle of a 100-degree day in Montana. But that means I got to close all the windows and try to, record this episode, essentially like hotboxing myself. And so, these investing episodes are taking about 45 to 50 minutes, maybe a little longer. A lot to talk about. Investing is, it's for a lot of people, it's kind of a foreign thing, not just in concept, but in language. And we've tried to, in this series, make it more approachable. Episode 101, the first part, just kind of like a college course, or like freshman English when you go into high school. We just try to call attention to why investing is even a thing. You can't just sit on your money and let it not grow because everything gets more expensive over time. You can't just live by spending 100% of your paycheck because eventually you're not going to want to work and you're going to need savings, and the savings needs to grow and do better than inflation so that you can at least have, when you are done working, you can at least have, the same kind of lifestyle that you have while you're working. And ideally, you're investing it, and so you're racing ahead, and you're going to have a better lifestyle. Or maybe you can just retire earlier and have the same lifestyle but not working and not work for longer. Either of those outcomes is great. On our visit here, met up with one of my best friends, known him for over 20 years, and we were just talking about sort of like my approach to finance and what I share with you guys through the Military Wealth Coach, which is money is a measure of our time and our energy. And if you want to spend most of your time and energy working in order to spend that now, you're going to work for a long, long time. And if you would rather spend your time and energy doing what you love, being with your family and doing it when you have your health and your strength, which means not when you're 70, but in your 50s, hopefully even in your 40s, you need to save and invest so you have the financial freedom to live out your peak years and your years as a parent, not just slaving away. And the feedback I got from him was like, I don't really know how to do this stuff, and I'm already fairly, midlife. And so I think at this point, retiring at 70 is the only option. And that's, it's an eye-opener, right? But it also really underscores the purpose of the Military Wealth Coach community and this podcast, which is he's in his 40s and he's finally, talking to me about this stuff. He'd never really thought about it until his 40s, and now he's like, the mountain is still very tall and it's a steep mountain to climb. He's still making his way up through Camp 1 and Camp 2, on his way to get to the top of Everest, but it's going to take another 25, 30 years. But he will do it, right? He will do it. Like that $5 million retirement golden egg is within grasp, but it's still that far away. Well, if he can do it, if he's still saying like, I'm going to be able to do it by the time I'm 70, and he's really getting serious about it now in midlife, late 30s or early 40s, just imagine if you were doing it in your 20s, right? Like if you're doing it in your 20s, that same sort of mountaintop, that same $4 or $5 million nest egg net worth and the income that comes with it, 6-figure passive income every year that comes with it, true financial freedom. You've already brought that peak and reaching that peak forward to like your 50s, like an early, actual legit early retirement in your 50s into a multimillionaire status just because you're taking action now in your 20s. And if you want to be more aggressive and really go all in on it, not just do like the minimum, you can move that peak even closer and spend even less time climbing the mountain top and more time, living at the mountaintop. So, and that's sort of like this 4-part investment series is taking us from understanding why we should do it. In the second episode 201, we got a little bit more advanced. We started talking about why investing works and like compound returns. And we also talked about, like what diversification means, what risk means, and some of these a little bit more advanced, like sophomore year type terms. And today in 301, we're actually going to talk about choosing your investments. And that's because at this point, we've got to do a little bit extra work. And when I say a little bit extra, I'm emphasizing a little bit because it's honestly, it's not much. We built this buy box in our first 2 episodes. We put 5 sides. So we got the bottom, the 4 sides of the box, and the top still open. And the point is that we use this buy box to like fill things in the top. But we're going to have more things that fit in the box than we actually want to invest. And so we still need to do, today we're going to talk about the last couple little things that you do in order to finally choose. If you've got 5 things that made it into your buy box, 5 different mutual funds or 5 different exchange traded funds that made it into your buy box. Today we're going to talk about the last steps needed just to pick the best one. And if you've done that, right? If you've gone through these steps and you've done that, you've just taken, a universe of 100,000 investment options that are confusing and intimidating and lead most people to either, follow a formula that is generic and doesn't really work, like the whole like invest 40% in bonds when you also already have 10% in cash, and now the 50% of your money that's in stocks is not earning enough for you to ever make your goals. Or you do the ultimate, which is, ultimate surrender, which is you just, give up and you turn your money over to a financial advisor and they take 1% off the top. And now you have to do, just to compensate your financial advisor or your, wealth manager for doing the work for you, you have to magically come up with an extra 1% returns, which is it's actually really hard, right? Like you have to be really aggressive at the start, investing almost 100% in stocks just to make sure that you're reaching that minimum threshold, that 8% total return or inflation adjusted return. Well, now just imagine, and that means you're getting 10% plus or minus on your stock portfolio blended with whatever you're getting on your cash and other stuff just to make it. Well, now if you've got to pay a financial advisor 1%, you've got to find an extra 1% out there. You've got to be doing 11, 12% on your stocks, and it can start to get risky. So today we're going to just finish this kind of narrative on choosing your investments. At the end of the day, at the end of this episode, you're going to have a process that you can follow. You can it's going to show you why there's only one choice in the TSP and makes the TSP a one and done deal. Like you literally have to click one time what allocation you want and then don't ever think about it again. But then for your brokerage account, whether that's with Schwab, Fidelity, TD Ameritrade, E-Trade, Robinhood, Vanguard, whatever, you'll have this sort of like quick 10-minute drill that you can do to go through, rack and stack the investment options, see what fits for your buy box and your strategy, and you'll be done. You just click it, buy it, set up the recurring investments, and you can literally have in 10 minutes do all the work you need for the next 10 years, right? And now who needs to stress? It takes the stress out of it, and it also, it allows you to just automate everything, and you do it cheaply, almost free, right? So today's episode, what we're gonna do is we're gonna combine that new information with just kind of like a detailed walkthrough of the system and the process with the buy box. And so it's basically 3 segments, right? In the first segment, we're just gonna talk through how we've used our filters to get ourselves down to like that 5 or 6 candidates. And then in the second segment, we're going to bring in a couple new things to look at. Public information, it's published with every investment you can ever make. Like it's usually like in the first 5 or 6 lines when you look at it. You don't even have to like scroll to the second page or click on a link. Like you just, whether it's Yahoo Finance or, a dashboard in Vanguard, it's right there staring at the face, these numbers. So they're very accessible and they're easy to understand. And that helps you make your choice. And then the third segment is, we're going to add a couple more. It's more of like a teaser, right, of how you compare apples to oranges. Because we keep telling you, like, real estate is great and having investments is imperative, critical, necessary to have a good portfolio. Well, it's a little bit of a different flavor. And so we'll call them oranges. And at the end of this episode, we want to at least give you that preview or that teaser of how can I compare a stock investment to a real estate investment, because I still might have hesitation. Even if I find the best mutual fund out there and I'm ready to buy, I might still be thinking like, should I do that? Or should I still hang on and like go after real estate? And you can still use a couple simple numbers to say, what should I do? All right. And that's where we'll conclude. Now, just as in our first 2 episodes, grab your green notebook, grab an ink stick. That's what we call pens in the Marine Corps, right? I never ask if other services call them pens or ink sticks. That's what it is. And we're going to open the fire hose and just get ready to take notes. All of these episodes are chock full of golden nuggets. There's probably more in this one than anything we've done yet. And so, listen, rewind, pause, whatever, take the notes, study it, because when you're done, you'll have the tools you need and to build a strategy and be an active investor. While you're at it, make sure you go over to www.militarywealthcoach.com and opt in to our weekly newsletter, and also add your name to the pre-order list for our free mini course, Budget Bootcamp. Eventually, we'll try to sell it behind a paywall, but it'll be free for the first 100 who sign up. So obviously, we're not there yet, but we also said it was going to be done in July, and it's already August, and that's because, well, dad life, right? If you're not a dad, maybe you're not ready for it, or you can't relate. But if you are, you probably have a good idea of how the days and weeks can get away from you when it comes to side hustles or passion projects or hobbies, right? So we're almost done. It's coming, and if you opt in, you will get automatically notified when it is live, and you'll get a download link automatic. So the easiest thing to do is, instead of waiting for me or checking the website, is to just go ahead and opt in, and then you'll get a notification when it's live, and you'll be ready to take your course. Now, again, our standard disclaimer is, when we're talking about investments, all investing is risky. This is not financial advice. These are tips and strategies that help you make your own decisions, and you also need to do your own research. And of course, when in doubt, consult with a professional. All right, so where is our buy box? All right, so with the first episode, what we did is we put 3 kind of rules or 3 sides to our buy box out there, and we really wanted to underscore, first and foremost, you've always got to have every dollar in your sort of universe or your system earning at least 3.1% interest. So we start with that floor of the okay, I need 3.1%. What should I do? I should immediately take action. I go out, any money that's sitting in a checking account or a savings account that I don't need, right? Like if you only need one checking account, but you have 2 different banks with checking accounts, maybe you need that second one open, so you should have like $12 in there, right? Like don't have like $5,000 in there. Move that into a high yield savings account, or maybe go buy certificates of deposit, CDs, right? You need to get as much as of your money as possible into this. With obviously this all depends also on having a budget, because if you move it all now, but you've got $2,000 worth of bills coming up in the next 3 days and you don't have that much in your checking account, oops, you're overdrawn or you have to undo things, right? So we're not talking about the day-to-day expenses and the money in that checking account, but all the other accounts, and definitely never a savings account. That just all needs to move, and it's going into something. The important part there, too, is the 3.1% rule provides our first filter between investments that are good enough and those that aren't good enough. And just for an experiment, what I did as I was putting down my notes prior to this episode, recording this episode, is I logged into USAA.com, just like pretty much everyone in uniform. We are a member. But I went to their certificates of deposit page, and I was like, let's see what they offer, because we do a CD ladder with them. And I looked, and they actually have 16 different CDs. They range from 30 days all the way out to 7 years. Well, only 6 out of those 16 are paying at least 3.1% interest. So just from my first, little rule in my buy box of the 3.1%, I'm able to one, take action and move all this sort of like idle, static cash or wealth out of wasteful accounts like checking and savings accounts and put them to work, put my money to work, earning interest. I'm also able to quickly narrow down what actually I can even put it into, right? Like in this case, over 60% of USAA's certificates of deposit don't meet that threshold. So I don't even have to consider them. Now I just look at, it turns out the ones that do are the 6-month, 9-month, 12-month, 15-month, 18-month, and 2 years. So now I just need to really see what I'm comfortable with. If I have, $8,000 in my emergency savings fund, maybe putting $1,000 in a 6-month CD is just fine. If I have $20,000 in my emergency savings fund, maybe I can put, half of that into a 2-year CD, because I still have $10,000 cash that is accessible, So these are, you're immediately able to take action on that. Of course, the second rule that we talked about is, for our buy box filter, is this attitude that you look at your money that's being invested as being sent off to work or being sent off to summer camp for 10 years. And the reason is that there's a lot of risk on the daily, weekly, monthly, yearly from investing in the stock market. What I've done is, I think we touched on this before, but I've done the math, okay? And I just want you to kind of visualize this. Bear with me. You don't have to write down the numbers, but just kind of think about it. And on the daily, the stock market, and this is from over the past 109 plus years, the stock market, the S&P 500, on a daily basis has a 47% chance of finishing down, only a 53% chance of finishing up. It's not much better than a coin flip on the daily basis. But the little bits count. And over the course of a year, you've got a 2 out of 3 chance to finish in the profits. So our chance of losing on the daily basis is 47%, basically a coin flip. But in 1 year, it goes down to 32%. And that's just because, out of the past 100 plus years, the S&P is like 97 years old or whatever. And the U.S. stock market's older, so we have more data. But the S&P itself has had like 30 down years out of like 97, right? So that's a 1 in 3 chance that on a yearly basis you'll lose money. Now, if you stretch it out to 5 years, it goes down to a 1 in 6 chance. 1 in 6 chance is still a little risky. Like if you're saving up for a car, that's still maybe, if you need $10,000 in year 5, you lose 15%. Now you only got $8,500. You don't have a car, right? So that 5 years is still a little bit risky. And that's why we've said any money that you have saved or invested for 5 years or less, for goals 5 years and inside, should not go into the stock market. Should just go into a high yield savings account and stay there. But at 10 years, right? At 10 years, it's 20 to 1 that we're going to be profitable. That risk of loss goes down to just over 4%. After 20 years, it's only about 1.5%. And when we get into the retirement planning or the long-term wealth planning, so 30 years, if you start in your 20s, 30 years is kind of like your early retirement planning time horizon, and 40 years is like your full retirement planning horizon. You have less than a 1% chance of losing money. In fact, it's 1 in 500 chance that if you your whole life save, let's say you save $500,000 in your paycheck, you've got a 1 in 500 chance of having $500,000 or less when you're finished if you invested in the stock market. But the other 499 chances out of that 500 is that you're going to have $1 million, $2 million, $4 million, $8 million, right? So in the long run, and really starting at 10 years and on out, the number's really on our side. And so, we've now that with that second side of our buy box, that second rule of saying like it's a 10-year attitude, that makes it simple, right? Because we can again take action. We divide up all our savings goals and we see anything that's like 5 years or less, like having emergency savings fund, saving for a new car, saving for a vacation, maybe saving to transition out of the military, whether it's retirement or just separating. Those things in 5 years, that money goes into a high-yield savings account that earns at least 3.1%. It's simple. Like there's no guesswork in this anymore. If it's 6 or 8 years or longer, 10 years or longer, then you just put it into a stock market and you go after more aggressive returns. Now, there's a second advantage to this, and that's like when you actually start comparing, like the stuff that goes into your buy box that you start comparing. I'm sure most, if not all of you, have some investments and you've looked at what you own and you've looked at the performance data. Like even if it's just you've logged into TSP and you've looked at the C fund and said, what's the return history and the performance? And you see there's year to date, 3 month, 6 month, 1 year, 3 year, 5 year, 10 year, since inception, all time, 30 year. Like there's all these different time frames. And when you're looking at those, it can be intimidating. And it can be really confusing. Imagine in, March of 2020 or at any point in 2022 when the market was moving down. If you looked at like the year to date or the 3 month or even the 1 year returns on a mutual fund, you'd see it's down. And you're like, oh, this is a horrible investment. I can't do this. But what sense does that make? You're not investing in the stock market for next November or next summer's, holiday trip home. That's safely stashed away in cash in a high yield savings account. You're investing for the long run. You're investing for 10 years, maybe 6 to 8, but definitely 10 years. And so what this allows you to do when you're actually logged into your brokerage or logged into the TSP is you can just move your eyes to that 10-year line or maybe since inception, which means since the fund was formed. So maybe like mutual fund was like created in 2016. So it's only got 8 years of data. So it doesn't have a 10-year return, but you can see 8 years is, that's within our range. And so now you, instead of getting distracted by all the noise and all this short-term stuff and worrying about what's going to happen this week, next month, next year with the stock market, you can just look at that 10-year line. Right, so now we've simplified things once again. There are so many mutual funds, and you can get a good taste for it just by logging into. If you just Google TSP funds performance, you'll link directly into the TSP performance tab where you can see side by side all of their funds, and you can see what I mean. Right, you'll see that on the 1 year or the year to date, there's all sorts of noise. You have some life cycle funds that are doing okay this year, but in general, they're not. You can see that, but instead of getting confused or sidetracked by that, just remember the TSP is for your retirement. It's for 30 to 40 years from now. So the only thing you need to do is look at 10 years or longer, 10 years or since inception, if they've been around longer than 10 years. And when you do that, it makes it simple, right? Because the C fund absolutely destroys every other fund TSP offers. And if your goal is to have more money at the end of your working time and more money in retirement, like your TSP strategy is not complete, right? Like you just buy the C fund, like invest $500 a month in the C fund or whatever, and you are going to be, $575 every month in the C fund, and you're set. There's one other thing that I just want to talk about that is, I think, really important with this like 10-year rule. And that is, it should also help you take action, not just simplify the process of comparing options and like getting to the point where you're ready to invest, but it should also be one of the things that pushes you across the line to invest. Now, if you look at the S&P 500 from 1993 to 2013, okay, so that includes the dot-com bubble that burst, which wiped out like a third of the stock market, and it also includes the Great Recession from 2007 to 2009, which again wiped out like a third of the stock market. In fact, I think the dot-com bubble was even worth like over half of the stock market's value got wiped out. So those were two major stock market crashes and recessions, and they're included in this 20-year period. Two things that we can look at. Let's just focus on from the 10-year standpoint first. In 1993, the S&P passed $1,000 for the first time. The following year, in 1994, it crossed the $1,000. So between 93 and 94, it went over $1,000, came back down, then went over $1,000. It's never been that low ever since. Even after the dot-com bubble, even after the Great Recession, the S&P never touched $1,000 again. Chances are you'll never see lower prices in the S&P 500 than you are this year. Maybe next year will be a little bit lower, but 5 years, 10 years from now, you'll never see it again. So you should just be able to confidently start investing right now instead of holding back and sitting on the sidelines. Now, the other thing that this is useful for, maybe it's a little bit of a tangent or off topic, but I think it's really, really important for us to grow and mature as investors. Over that same period from 1993 to 2013, through two major stock market cataclysms, right? Like just absolute disasters, the dot-com bubble especially, but the Great Recession was also pretty nasty. Through that 20 years, the S&P 500 still averaged 9.2% per year, which if you were taking notes, when we were taking notes during episode 201, when we said 9.2% is what you need for after inflation to have 8% total real return, which is the golden number, the target you have to reach your investment goals. That means from 93 to 2013, if you kept your eyes on the prize of like 10 years plus outlook, you were still going to get 9.2% per year or 8% adjusted for inflation, which means you were still on track. You were going to more than quadruple your wealth in that 20 years despite the two stock market crashes. But you know what happened? The average retail investor, and the retail investor is meant to talk about people like you and I. People have our brokerage accounts. We put a few $100, a few $1,000 in there every month or year. We make our own decisions. We're not professionals. We're not big banks. We're not, insurance companies or pension funds. We're just average people who trade on the stock market through an app, right? We're retail investors. And over that 20-year period, the average retail investor only got 2.6%. They got wiped out. They got destroyed. And why did that happen? The average investor doesn't have that 10-year perspective. And when they saw the stock market go down, 2000, the floor is bottoming, falling out. The two things happen. One is we're going to talk about it in episode 401 is how to protect or manage your investments. Like they didn't have stop losses built in, which is another automation that you will learn to put in, and we'll talk about next week, so that if the market goes down 50%, you automatically sold off at like say down 10% or 15% or whatever you're comfortable with. So you protect yourself. They didn't have that, so they took big losses, and then they made it worse. They locked in their losses by selling. For those of you who may have been invested during 2020, during the COVID crash, you probably at least saw or know people who did this same mistake. They repeated the mistake, and most of them are guys who are in their, guys and gals in their 50s and 60s who probably did the same exact thing during the dot-com bubble and did the same exact thing during the Great Recession. And then they did it a third time, during the COVID recession is when the bottom fell out and they were down 20, 25, 30%. They panicked and they sold. And the result of that is that their returns are about a quarter of what they should be because they locked in these huge losses and they didn't get the profits on the rebound. So with this 10-year, this 10-year attitude or vision that you are taking with you into your investing life is going to do for you is it's going to help you get started right now, because you know that you're probably not going to see this level again. So it's about the cheapest you'll ever be able to start investing. And when things get choppy, you're going to stay the course, because you don't want to sell and lock in a loss and end up averaging 2.6% a year. You want to stay the course, continue to invest a little bit every month, stay true to your strategy, and even through a really bad period, walk away with that 9.2% that you need in order to become wealthy. All right. And so the 10 years just, it's an awesome part of building a buy box, is just because it's a mindset and an attitude thing. And then number 3 was to budget, safely, consistently put $200, $500, $700 a month into your investment accounts. And then you just keep doing it, right? And that you don't second guess yourself. You don't try to time the market, right? And you've probably heard that if you listen to any other sources of, financial strategy or tips or advice. People always, they talk about like, don't try to time the market. Don't try to time the market. They just, it's a principle, right? It's a rule. And that's why it's in our buy box. You got to every month have an affordable amount so you don't miss any deposits and you don't skip them and you don't get cold feet. The headlines are all saying like, when's the recession going to start? Has it already started? Is there a recession? And so, these folks, they said, let's go back to the last one, the Great Recession, and let's compare what would happen if you just stuck it out compared to if you actually perfectly sold before the crash and then perfectly bought in when the recovery started. Or what if you just sat on the sidelines? What if you sold off everything right before the crash, perfectly timed it, and then you bought back in 2013 when it recovered, right? So you avoided the loss at all, but you also missed that upside. And this is what they found. If you sat on the sidelines, if you started with $100,000 and you sat on the sidelines, and then you started investing again, you would end up with $138,000 by the end of the window. If you didn't do anything and you just kept investing, you do $148,000 by the end of 2013. So you literally, even though you took the big loss in 2008, because you continued to invest and you bought at the bottom and bought all the way up, you're going to do $10,000 better than the person who missed the crash, like perfectly got out before the crash and was like super stressed about it. You can do better than them. Now, the guy who picked it perfectly and sold right before the crash and then bought back in right before the recovery, they did the best, but they only had $156,000, which means they only were $8,000 better off by, this ability to time the market. And let's be honest. If you're selling off your stocks, you probably have a taxable event. You're probably going to have to pay some capital gains taxes, and that'll eat into that $8,000 advantage that you had. And you probably put a lot of time and a lot of stress into trying to predict it and guess it. And your actual, I tried to do the math, but I broke the calculator because it's like one with 100 zeros, like a Googleplex, is the chance that you would actually do that correctly twice, perfectly. So like you're literally saying like for impossible odds, are you going to stress about the market and try to day trade and like predict recessions and predict recoveries and like get it just right for a reward of, $8,000 in this particular case. So really, at this point, like you have this attitude of like, just set it and forget it. Run everything through your buy box, do the filters that we're going to, finish up today, getting all the way through. Make your investment with a 10-year attitude, the attitude you're going to consistently invest every month, and you have zero chance of doing better by trying to second guess things or time the market. And you're just going to be ready to take action. And so again, we're moving through and we want to show now we've got the right attitude. We're ready to take action. We've got our money. We know that we need to invest it. Everything that's not in a high yield savings account. And that was our 4th rule, which is you got to target the 8% total real return. And so long as you're over 10 plus years, you're investing, you're going to get that number if you invest in the stock market. To hammer this home, right? Because I've talked to plenty of young officers and and young Marines who are like, you know, why do you officers always talk about investing? Why do you always talk about this, that, and the other? You know, like, well, knowledge is power, right? Knowledge is real power. But what effect does that power have? Let's talk. I think I brought this up before in the podcast. Is Vicki Robin in her book, and sorry, like for some reason I'm like blanking on the title right now. Oh, Your Money or Your Life, right? Your Money or Your Life by Vicki Robin, and she says that your money is nothing more than a measure of your. She calls it like your life's energy or your lifeblood, but it's a really good way to translate why it matters that you get 8% and why we have this fourth part of our buy box. We've only got one more to go, and everyone's got to be important. If we're only going to have 5 things that shape our strategy, our buy box, and why is this important? You are trading your time. You are serving your country, and that's brilliant and respectful and respectable and honorable, and we thank you for it. You shouldn't suffer financially, right? You shouldn't suffer financially, and you also, if you're going to keep grinding and working that hard, like you can't do it forever, but you definitely don't want to do it forever. Like, we're all looking to get to the finish line or the top of the mountain as soon as we can. Well, 1% difference in returns on your portfolio can be measured in years of your life. Taking the same strategy, if you can get 8% inflation-adjusted return, now compare that to you only get 7%, right? Because you're a little bit afraid. You didn't trust the numbers. You still backed off. You put bonds in your TSP and dragged your returns down, and now you're only getting 7% adjusted for inflation. In order to get to the same retirement goal, you're going to have to work and save for 4 more years, right? Like 1% in terms of returns on your investments is worth like 4 years of your life. I'm more than willing to take on a little bit of risk to get that extra % return in order to get 4 years of my freedom back at the end. And this is no small joke, all right? Or small matter. It's no joke, because the traditional strategy and the things that we rail against here in the military wealth coach community is the idea that you should rebalance and add bonds to your portfolio. Look, you've already got cash and high yield savings accounts, right? So you already have 10, 20, 30, 40% of your wealth in cash at some point in your life. That's only getting 3.1%. You need to have as much money as you can aggressively earning that 10, 11% that you get from stocks. If you put in some bonds that only get 5%, it pulls you down. And the life cycle funds in the TSP do exactly that. Every 3 years, those are rebalanced, right? You're supposed to buy the life cycle fund that has the year in the name that matches up to when you think you'll retire. So if you're born in 2000 or 2002, 2003, somewhere in there, like you're supposed to put all your money in the life cycle, the L60 or 2065 fund. And every 3 years, they're adding more and more bonds. And they actually go from, you've got like basically 99% stocks for the first 10 or 15 years, but then they go down, down, down. And they eventually get you down to having 80% bonds, right? Now, when you look at that, the effect of that is the life cycle funds over the course of investing, right? So not just this year, not just the first 5 years, but over you start investing when you're 22 all the way to 65. The life cycle funds never once will give you 8% total real returns. And in fact, this was kind of scary, but I took an generic enlisted person. I said they start investing at age 22, and they're doing the $550, $575 a month that we recommend for our ultimate retirement plan. If they invest in the life cycle funds, it will take them until age 67 to hit $1.5 million, right? That's 43 years to get $1.5 million, which, again, we've addressed this elsewhere, but that's not enough. You need like at least $2.5 million. If they instead were investing in a mix of like the C fund and like high yield savings accounts, like cash in the high yield savings account, and then 70% is just in the C fund, they're going to hit 1.5 million at age 57. That's 10 years faster than the life cycle strategy will get you. All right. So And in fact, by age 67, they're going to have 3.3 million. So they're going to be more. They're going to be good, right? The life cycle products or strategy that TSP sells you will basically guarantee only one thing, and that's you won't have enough money to retire. So anyway, in the TSP, this simplifies things, right? Like that immediately eliminates, I think they've got 10 life cycle funds, and then they've got 5 of their regular strategy funds. Just by knowing that you need to get 8% total real returns on your investment, it totally eliminates all 10 of those life cycle funds. You can forget about it right now. If you read the military money manual where they're like, man, if I could have just changed one thing in my military career, I'd go back and set up automatic TSP investments in the life cycle funds. No, don't. That is the worst financial advice or strategy I have ever read in anything I've read about military money, right? Like, don't do it. Life cycle funds are the enemy. Well, in our upcoming book on the ultimate military retirement plan, I break it down line by line. You can see all the charts and all the numbers. I show you exactly how that works to undermine your goals, right? And also, in the broader universe of mutual funds that you're going to be investing in your brokerage account outside the TSP, the money that you're saving and investing to buy a house in 10 years to, create enough wealth to support your kids through college and pay for weddings and buy your dream home, retire early, whatever it is. Again, you can just simply sort those things. And you already have the 10-year rule, which is like you only care about 10-year performance to smooth out all those lumps. You can just log into like Vanguard, check the filter to look at Vanguard mutual funds that are equities. And then you sort the 10-year column. And anything that is, less than about 9 or 9.5%, once you adjust for inflation, it's not going to make it. And you can just delete all those. You're going to end up eliminating 60 to 70% of the noise out there. And finally, we talked about the fifth and final side to our buy box that we talked about through the first 2 episodes was the diversification, right? Risk and diversification. And you hear all the time. And that's like the bread and butter of the financial advisory services is they explain like, oh, just follow our strategy, pay us 1%, and we'll show you how to diversify and like balance and like optimize. Well, none of that is going to actually be necessary. Why? Because when you invest in the C fund in your TSP or you invest in an S&P 500 index fund, that single investment, call it just $100 or $1,000, is investing in 500 different companies across 11 different sectors of the U.S. economy. The point is, instead of overthinking it and trying to like do this diversification, which is making things more complicated, you just buy the S&P 500. It's like already diversified for you. Well, if trying to like game the system and do your own diversification and somehow do it better than the S&P 500 is like your goal, you're going to take on more risk and you better get more returns. That we've referenced in a recent blog post, a Morningstar report that compared what happens in trying to like do more balancing or sector weighting and not just investing in the index fund. And it actually results in about 1% lower returns, right? So you're going to take on more risk and get lower returns. So you don't need it. So now we've our buy box at this point for our stock portfolio it's super small. We're looking for index funds for the S&P 500 that over 10 years are paying out at least 9.2%. And that's the short list, right? So let's just quick, before we jump into the second segment, we just look at like where you are with your money. And like, let's just say that you had a $20,000 enlistment bonus or like $20,000, you took a $20,000 career starter loan. I know it's not 20. I know it's 32 or 35, but like just pick 20 as an even number that could apply to everybody, right? And, let's say you need to buy a car, right? So you buy a car and now you've got $12,000 left and you want to put $5,000 in your emergency savings fund. Well, you'd go out and you open a high yield savings account, put $5,000 in there, earning 3.1% or earning at least 3.1%, but right now about 5%. Okay. And now you've got another $7,000 left. You go over to your brokerage account, you open it up, log in, pull up the list, filter for equity funds, filter for mutual funds, sort by 10 years, look for the return. Everything over 9.2 or 9.5% thereabouts is going to get you that 8% inflation adjusted return. And now that's your basket. Like that's like, I don't know, depending on the brokerage, like 3 or 4 or 6 or 7 different funds. And that's it. You're going to be diversified. You're going to be risk optimized. And so now it just comes down to, how do I pick that one? And that's sort of the last 2 things that we're going to talk about in terms of making your final investment decision, picking the best one, because they're apples to apples, but you can still find a best one. Now there are dozens of ratios out there, and you can go down major rabbit holes trying to split hairs and like, should I look at the Sharpe ratio or Sortino ratio or Trainer's ratio or Trainer's alpha, or like all these different things that guys who are managing like billions of dollars, like they have to worry about, because 0.1% of a billion is still, millions of dollars, right? And so they have to care. But for you and I, like, we can just forget about it. It doesn't matter if we're comparing 2 mutual funds and like one has a Sharpe ratio of 1.08 and the other is 1.09. It's the same. It doesn't matter if one has a Sortino ratio of 0.95 and the other is 1.15. Like, if you understand what that means, you probably understand that one is going to have lower returns anyway, right? So don't stress about it. In fact, there's only 2 measurements that you really need to worry about, right? Now we're talking about index investing. So index mutual funds should have the same level of risk as the actual market. And that's measured by a thing called beta. So the beta of the mutual fund that you buy for the S&P 500 should be 1. If it's less, that's better. That means it's less risky, but the returns have still got to be good enough. If it's more than 1, it's not very efficient. It's taking on risk. So if I have, my buy box has got me to this point where I have like 5 S&P 500 index funds, I want to look at the beta. And if any is not 1, I got to throw it out, because it for something that they're doing with it, they're adding risk. And I don't need extra risk for not getting more returns. Beta it's just written, it's BETA. When you look at a fund, it's going to be right there on the dashboard. You can look it up, Yahoo Finance, Vanguard, E-Trade, whatever. It's right there, like above the fold, like the first thing that you see. Just make sure it's 1. If you're getting into like some riskier things and they're not index funds, but they're still, S&P like equal weighted funds, if the returns are the same, pick the one that has a lower beta, right? Because less risk, more reward. And then here's the real one. This is like the absolute like decision maker, and it always, always, always works. And that's the expense ratio. The mutual funds that are investing in the S&P 500 are all basically getting the same return. So you should just try to buy the one that's cheapest. So let's think about it this way. All right, you might be looking at one that is got an 11.08% average 10-year return, and there's another one that's 11.5%. You're like, 11.5% is better. I'm going to invest in that one. Before you invest, you have to look at the expense ratio. If the 11.08 return, like just these are actual fund numbers that I'm using, so I'm not like somebody who's just like coming up with random stuff, right? But 11.08%, and it costs 0.05% for the expense ratio. That means after expenses, you're getting 11.03%. Now this other one that's 11.5%, it's high flying. You're like, it's beating everybody. It's best in class. But you look at expense ratio and you see it's got a 0.6% expense ratio. That means it's actually only getting 10.9% after expenses. It's actually worse, and it's because of the expense ratio. Now, we've mentioned before in blog posts and in our books and stuff that 80% of professional, wealth advisors and financial advisors and fund managers do worse than an index fund. And that's because of the expenses. They actually get the same performance, the same, 11% returns, but their expense ratios are higher, and so they do worse. So you can do, by buying an index fund, You can do better than 80% of Wall Street and 80% of the pros by just buying an index fund that's as close to free as possible. And there actually are some out there. Again, we're not sponsored. We don't get kickbacks from anybody. Vanguard is traditionally the low cost fund leader, but Fidelity has started selling free mutual funds, which is pretty amazing. But again, it's just an index fund. It's run by bots that don't cost anybody anything, right? So, right, like the expense ratio is the game changer. It's the reason why 80% of professional funds cannot beat the benchmark is because the expense ratio, it's too much. And the 1% of professional investors and advisors who actually do better, those are special, and it's worth paying somebody extra. But those are usually closed off to people who have less than, $10, $50, $100,000 to invest. So that's not even really realistic. We're building a strategy, a beginner's investment strategy here that gets you to take action, gets you out the door, keeps you consistent, helps you avoid the panic sell and getting distracted by the shiny objects and the headlines, and just puts you on this like steady track to creating real wealth, to creating millions of dollars in wealth over the next 10, 20, 30, 40 years. And the most effective and most reliable strategy is just to invest in free or almost free S&P 500 index funds and just get the best return for a given price and a given risk, right? So, at this point, I think we're definitely going long today, but we're all the way up to segment 3. And segment 3 is how to compare and this is a bit of a teaser trailer, right? So nothing too in depth, but it's how do I now compare stocks versus something like real estate? Because I've been listening to the Military Wealth Coach, or maybe I have some, money mentors around my unit who keep telling me about real estate, and it's great. And it really is, right? But it's got a high barrier to entry. Like you can start investing in the stock market with $100 today. Probably not going to go buy any investment property for $100, right? So real estate's a bit of a longer play, and it actually works out really well if you are stock investing for like 6 to 8 years. You're doing a little cash savings for your first real estate purchase in the next 3 to 5 years, but then you also have a stock portfolio you're building up to make another purchase in 6 to 8 years, and another one in like 10 or 11 years, and another one in like 14 or 15 years. And so there are these trade-offs. So you still want to compare, because eventually you're going to have, say, $20,000 in your high yield savings account ready to invest, and you're going to have to ask yourself, like, should I put this $20,000 into buying a house, or should I put my $20,000 into the stock market? So you need some ways to compare that. The first one you can look at is return on investment. That's pretty simple. That's basically the percent returns that you're seeing when you look at a mutual fund and you say 10-year average annual return. Oh, it's 12.82%. That's the annual return on investment. Well, if you go and look at real estate, you're going to see on average in the U.S. market, it's about 3.5%. And so people, who you've talked to who hold out and say, like, I don't know why you invest in real estate. Like, you're not going to make any money there. A lot of times they're looking at 3.5%, and what they're not realizing is that real estate you get to buy with leverage, with a mortgage. So like $20,000 cash can buy $20,000 worth of stocks. And if the stocks go up by 12.8% per year, that's great. But that's still the ROI is on the cash invested is 12.8. Well, I can buy a $200,000 starter home, which the average starter home in the U.S. in 2024 is $191,000. So this is totally affordable nationwide. I can buy a $200,000 starter home with 10% down, whether it's a VA loan for myself to live in or an investor loan, 10% down to immediately start renting to tenants. 10% down can get me a house. So that's my $20,000 buying a $200,000 house. Well, let's look at it. That means I'm in a 10-to-1 leverage situation. That means I'm getting to keep the gains on all the 200 when I only invested 20. And what that ends up doing is it takes your compound annual return on investment, your ROI, up to close to 30%, 25 to 30%, because I'm using bank money to buy it, but I get to keep the profits on all the bank's money. And in the long run, that's really what it kind of settles down to, is because of the fact that you can buy real estate using a mortgage, the actual ROI on the actual cost invested, not on the house itself. The house itself is growing at 3.5% per year, but the money you put into it as an investment is giving you, depending on how much you put down, anywhere from 17 to infinite percentage, like a zero down VA loan, right? If you put zero cash down, that's pure infinite profit, right? And so what you can start to see is that because of mortgages and leverage, real estate is going to give you a better return on investment over the long haul. Now, the second part to consider is the cash flow. Now, if I buy $20,000 worth of stock, S&P 500 fund, that's going to give me about a 2% dividend yield. So 2%. Every year, I'm going to get $400 in cash on top of whatever the stock grew. And I'm not selling the stock, so I don't get to count that as an investment gain, but I get the $400 cash as a dividend. That makes the cash on cash return, right? Cash on cash return is how much cash did I get back for the cash I put in. It's very common in real estate. What we're just trying to do is compare it to stock market investing, which in the stocks, you tend to call it yield or dividend yield, but we're just saying cash on cash, right? So I put in $20,000 and each year I get $400 back. That's a 2% cash on cash return. I get 2% back in cash the first year. What about in real estate? Well, I took a look. I found some houses that are down there near their starter homes and like sort of the outskirts of Wilmington, North Carolina, just because I'm familiar with that part of the world and that market. I also did it in the Norfolk, Virginia Beach area. Good starter homes there in the same price range. Location's not ideal, right? They're a little bit farther out, but that's what you can do, and that's the price points. And in those markets, if you were to go and put that $20,000 and invest it in a house, you're going to end up with about a $2,200 mortgage payment. And that's at 6.92% in 2024 on a 30-year mortgage. Well, the BAH in those areas for staff NCOs, warrant officers, commission officers, from like 03 and up is like $2,400, $2,500, $2,600. So you could take that property, buy it 10% down, put your $20,000 in, and rent it out for $2,400, and you get a $2,200 a month mortgage payment. That's $200 of income, extra income, cash, and you're going to split it, right? You put half of it away for maintenance, which means $100 of profit per month in your pocket. Over the course of 12 months, over a year, that's $1,200. That's 3 times better than the dividend yield on stock markets. And that's why people who become financially free young, most of them do it with real estate, because real estate is growing in the background with an ROI just as good, if not better, than the stock market, but it's also putting a lot more cash in their pocket right now. And over time, those rents are going to go up and the cash flow is going to increase, and your mortgage will always stay the same. It's a beautiful, magical thing about U.S. real estate investing is you can get a 30-year mortgage that never changes. But this is what makes real estate such a great investment. And to compare it to the stock market, you need to look at that cash on cash return, aka the dividend yield, and look at the annual return on investment on the actual cash invested, not the appreciation of the actual house. At this point, you might be saying, like, why do I even think about stock markets? Because it's so complicated. Why don't I just go out and invest in real estate? Because it's just one house and the returns are better anyway. Well, as we said on the outset, like, you can start investing in stocks for $10 now, and you need at least $10,000, if not more, to buy real estate. So it's a longer play, and in the meantime, you might as well have that $10 invested earning 8, 9, 10, 11, 12%, so that you can get to your goals even faster. And then maybe 5 or 10 years from now, you're switching over from the stocks into full-time real estate. And at the end of the day, like, we have to remind ourselves that there are, 2024, there are 24.5 million self-made millionaires in America. And of those, over 19 million made it on real estate. Your best chance to create life-changing wealth and lifelong wealth is through real estate investing. But to get there, you need the cash. And the best way to grow cash and build up your war chest and get ready to become, financially free young is to start investing in the stock market. Forget bonds, forget all that other stuff. Get out of the cash accounts. And that's what the strategy looks like. All right. Like I said, lots of information today, lots of data and lots of numbers and things to think about. But we're in 301. This is Investing 301, which means that we're upperclassmen now. We've had some intros, some basics, and we're building on understanding. And we've also got some blog posts over at militarywealthcoach.com/blog that provide some written context for this, and then also in our book Surface and Wealth and our upcoming course Budget Bootcamp. All of those, we're going to talk about this and reinforce it. And so when you put all those things together, you can put in about 50 hours worth of reading and listening and studying, and it'll all come together for you. So that's it for this week. We got to get out of here. I am pouring sweat in this attic, and so even if I hadn't talked this much, it's time to get out of here. As always, please support, share the community, whether it's on Facebook, Instagram, TikTok, or Twitter. We're getting ready to relaunch our marketing strategy, which the first round did not work very well. So we're getting ready to relaunch it here in the coming weeks to really help promote the course and the brand and the podcast and everything. So as we start coming up in your feed again, the best thing you can do is repost this to the story, forward it to your friends, like it, follow, and just build a community and get the word out there. So, all right. That's it. We got to go. So until next time, which will be part 4 of our investing mini series, stay financially fit and mission ready.